Right now, the financial news machine is losing its mind. We've got headlines screaming about tariffs, recessions, and some are even predicting a 25% market crash.
We've only started this. We'll be lucky if we get out of this top to bottom only down 25% before it's all done.
Classic CNBC, right? And the internet is in awe of Warren Buffett's perfectly timed cash out before the market correction. His stock sales soared in 2024, and he's sitting on a record cash pile, over $300 billion, while the stock market is teetering on the edge of a bear market. At the same time, all my favorite personal finance creators like Humphrey Yang are posting videos about not timing the stock market. So here's the question. If the odds of a market drop are rising, should we really keep investing like nothing's wrong? Isn't that just lighting money on fire or trying to catch a falling knife? It feels like we're all suffering from a bit of cognitive dissonance, right? I'm a PhD economist, and today I'm cutting through the noise. We're diving into the original research behind the phrase that we all hear parroted over and over again. Time in the market beats timing the market. TLDR, it's not as airtight as you've been led to believe. I'll show you what the Charles Schwab study gets right, and more importantly, what it misses. And by the end, you'll have a smarter, more flexible strategy for investing during economic chaos without becoming a Wall Street bets addict or day trading your nest egg away. If you're ever wondering where the phrase time in the market beats timing the market actually comes from, it's not ancient wisdom, and no, your real estate agent didn't invent it either. Ken Fisher first said this phrase in a 2018 USA Today column, but the idea dates back to research from the 90s. Fun fact, the original quote actually included a pretty important caveat: almost always. It's kind of like how I tell people I never road rage most of the time, right? Since then, that phrase, minus the almost always, and all the same examples from Fisher's article have been repeated and popularized by numerous studies and financial gurus. But it's basically become collective wisdom. And today, we're going to pull it apart. The chart Humphrey uses comes from a Charles Schwab study called Does Market Timing Work? All sources are linked in the description. Let's dive in. Let's talk about the Charles Schwab paper. So here's the setup. Schwab compared 4 hypothetical investors who put in $2,000 a year every year for 20 years. Investor A bought at the lowest point every year. So let's just ignore the fact that if I had perfect foresight and knew exactly when that date would be, literally predicting the future, I'd be doing a lot more with my life than investing $2K a year. I'd be in Vegas, I'd be solving the JFK assassination, I'd be doing magic tricks at kids' birthday parties. Investor B invested immediately on January 1st every year. So no timing, just lump sum. Investor C has bad timing, always buying at the highest point of the year. Honestly, that's more relatable. And investor D stayed in cash. He procrastinated for 20 years. So in 20 years, he never spent a dime on stocks. Like, who does that? Maybe someone permanently banned from the SEC. So what's the lesson here? Don't stay in cash for 20 years. That's pretty obvious, right? But Schwab's main point is time in the market beats timing the market. So just invest immediately. Now, let's be real. Schwab wants you to invest immediately. That's how they make money. More investments equals more assets under management equals more revenue. That said, Schwab is a reputable firm, and they attract smart people who produce solid research, so it's worth taking a closer look. While the article makes a strong case for investing immediately in most scenarios, the real world introduces complexities that challenge this conclusion. Now, I'm going to show 3 counterpoints and explain why time in the market beats timing the market is more of a gross oversimplification by going deeper into the core assumptions of the paper. Counterpoint 1. Sequence of return risk. So think a retiree versus a young investor. A core assumption of the study is a 20-year investment period in the S&P 500, and they use 2003 to 2022. So you might be wondering, no, it actually doesn't make a big difference which 20-year period, and they also examine 30, 40, and 50-year periods for consistency. But they don't do shorter periods than 20 years. And why? The reason is their conclusion falls apart for time horizons less than 20 years. So who should care about their conclusion failing? Well, let's say you're a retiree or near retirement. You face sequence of return risk, which just means early losses during retirement can be catastrophic. And studies like Bill Bengen's research on the 4% rule further support this. This counterpoint also applies if you're investing for a different goal with a shorter time horizon. So let's just say you're looking to make a down payment on a house and you're saving for that, or you're saving for your kid's college fund and your time horizon is more like 10 years. So let me illustrate with one example from Portfolio Visualizer, and you can replicate this using my settings. So for example, during a 10-year period between 1999 and 2008, you would have actually been better off sitting in cash than investing in stocks. So seriously, over a decade, the cash investor outperformed the lump sum stock investor. Now, you might say, well, Chris, you cherry picked a time right before the dot-com bubble, right? A time when there was irrational exuberance about the promise of a new technology that would permeate into every aspect of our lives and disrupt the labor market. I mean, we're definitely not feeling that type of hype anymore, are we? So what can we do if our time horizon is shorter than the 20 years required by the Charles Schwab researchers? Well, practically, this is actually a really good time to check your portfolio allocation. Are you too heavily weighted towards stocks from the recent bull market? It's time to rebalance and potentially err on the side of being more defensive. Tactical adjustments or just reducing exposure during market peaks can protect portfolios from catastrophic drawdowns. And yeah, that's basically market timing. Warren Buffett.
No wonder this circuit failed. It says made in Japan.
What do you mean, Doc? All the best stuff is made in Japan.
Unbelievable.
Counterpoint number 2, U.S.-centric bias. The study only looks at U.S. stocks during a period when the U.S. was the world's undisputed economic superpower. It's missing the global context that nations themselves go through rises and falls. So you'll have once great countries go into decline and then suffer prolonged downturns. So take, for example, Japan's lost decades. Remember all those movies from the late 80s when Japan was seen as all-powerful, unstoppable?
Nakatomi Plaza. It's the most important monument in all of America.
And then their economy just collapsed. If you invested in the Nikkei in 1990, you'd still be underwater until 2024. That's over 3 decades of nothing. It's a cautionary tale against over-relying on one country's market, even if it's the US. And it's not just Japan. Look at Great Britain in the early 1970s. Inflation hit 25%. They had labor strikes everywhere, and their stock market lost 73% of its value. I mean, thank God American dominance is rock solid right now, right? The authors actually acknowledge this with a disclaimer at the very bottom of their study. They say, lastly, it's important to note there's no guarantee you'll make money through investing in stocks. For instance, there's always a chance that we could enter into another period like the 1960s through early 1980s. So those were actually bad times. So something actionable to do here is counteract US-centric bias by diversifying globally. Don't just park everything in the US, in the S&P. Invest in a total international fund that includes both emerging markets and developed markets. If you're anything like my mom, she just refuses to buy any substantial share of international stocks because, according to her, US stocks have been doing so well and international stocks have been doing so poorly lately. So she's really underweight international, and I actually have to trick her into buying the total world stock index, which is 40% international stock mixed in there with US stocks. Counterpoint number 3, investor psychology. So one part of the Schwab paper that feels a bit detached from reality is the assumption that people are just going to stick to the exact same investing strategy for 20 years. That's 2 decades. Like no major life changes, no emergencies, no job loss, marriage, or surprise twins. Come on. It's like they're imagining some perfectly rational, emotionless investor, basically Spock with a brokerage account. And I love space travel as much as the next person, but there's just That's not how most people operate. Research by Kahneman and Tversky show that losses feel twice as powerful as gains, which is why panic selling is more common than we'd like to admit. And I'm not immune to it either. I did my PhD in behavioral economics, and I still feel that gut punch when my portfolio drops. Now picture this. You just got your tax return or a big bonus, or you sold your house. And do you really have the wherewithal to just lump sum that money into the market at once? Most financial advisors are going to tell you to set automatic investments and dollar cost average. But even with automation, blindly throwing money into the market can feel like sticking your head in the sand. I mean, I should be ignoring the financial news and reading Tolstoy, but I'm greedy. I don't want to lose my nest egg. So here's my approach. I don't aim to be a perfect investor. I just want to be a better imperfect investor. I know I'm not a robot. I know I can't eat ice cream all the time because it's going to make me fat. But when I get stressed, God, I just want to eat some ice cream, right? So same thing with investing. I get that sitting on cash has an opportunity cost. But as humans, we have a deep psychological need to know what is going to happen in the future and then to optimize our lives around it. And to deny that basic human desire is just not realistic. So here's my compromise. It's okay to have a tactical reserve, whether that's bonds, short-term tips, 4-week T-bills, or just plain old cash. But the key is not sitting on cash forever and letting fear keep you on the sidelines. Instead, the key is to set up a rule-based system, something that pre-commits you to invest that cash over a set time frame while adapting to market drops. And no, it doesn't have to be complicated. It can be as simple as a spreadsheet that just says, for every 5% market drop, I'll accelerate my automatic investments. This kind of system helps you stay flexible, reduces emotional decision making, and keeps you from falling into the trap of waiting for the perfect moment. Because, as a spoiler, there isn't one. So if you want a deep dive on how to set up a system like this, drop a comment below and I'll make a follow-up video. I have to admit, the Warren Buffett news and Humphrey's video led me down a whole rabbit hole. Here's my take on the Charles Schwab research. Time in the market beats timing the market. It's a catchy slogan, but real life is messier. Your time horizon, the global picture, and your own psychology, they all matter. And in today's chaotic market, a smarter, more flexible approach could serve you better. You don't need to be a perfect investor. You just need to be a better imperfect investor. If you found this breakdown helpful, hit subscribe. And I'd love to hear how you're handling today's market. Please drop your thoughts in the comments. Because at the end of the day, the best thing money can buy is financial independence.